Greetings from our team at Robare and Jones Wealth Management. This is Jack Jones, the managing partner, with our March monthly market update. Before we begin, I want to thank our clients for the trust and confidence that you place in us. The very best part of our day is time spent directly serving you. We hope to see many of you next month at our quarterly investment forum on April 24th. You'll be getting an invite about that soon. We also hope to have many of you join us at our Family Love Letter webinar on March 21st at 11 a.m. You should have received invitations about that. If for any reason you don't have that, please contact our office. We also sent an announcement out recently regarding some name changes. Nothing changes between our clients being the very highest priority to us as we serve them, and these various institutions serve us. So we mentioned some name changes. Triad Hybrid Solutions will be Osaic Advisory. Triad Advisors will be Osaic Wealth. Fidelity remains the custodian. These are mainly back office changes. The way you interface with us will remain unchanged, but we wanted to make sure you were aware of that, and you'll be getting mailings on that in the coming weeks and months. So markets remain strong in February, closing near all-time highs on Leap Day at 5096 on the S&P 500. The economy remains relatively strong. The last read on quarterly GDP is 3.2. Since we know the consumer drives 70% of GDP, we always like to check in on how they're faring. And there's some warning spots to be thinking about. One is the debt service ratio, which means what percentage of overall household income is going to service debt. You see that's gone up dramatically. That's driven by two things. Number one, overall debt is up, and also interest rates are up. So the cost of servicing that higher debt is up. So that's something to keep an eye on. Also, delinquencies are picking up on auto and credit card, also something to keep an eye on. As is the excess cash that's accumulated, that is now much lower than it was at peak at 2.3 trillion during the pandemic. So those are two things to keep an eye on as it relates to the consumer. We are entering a time where the speculation deals with when will the Fed cut rates for the first time. The Fed last raised rates in July of 2023. On average, there's a 10.5-month period between the last raise and the first cut. That would put us in the summer of 24 as the first cut if average follows. And if we look at a period of time in fixed assets, 1 year after, 6 months after the last rate hike, those are pretty supportive of fixed interest investments. So that period of time since the last raise was July, that would put us in a period of time, still be determined, but that just started about a month ago, January 26th of 24 to 25. Obviously, these are question marks, but overall, this is a good period of time for these fixed assets. When will the Fed cut? This is increasingly unlikely that we'll get a March cut, but you see how probabilities as we go throughout the year go up. So our base case is the Fed does some cutting in the back half of this year. At what pace, how many times, and when that starts is yet to be determined. So we had a jobs report just this morning. Before we talk about February, let's revisit January a bit, because January was reported as a very hot jobs number. At up 353, but we know from this morning the revisions were down 167. So this was much less hot than reported in January. Only 229 was the actual number in January versus 353. Now, connected to that, February jobs report, 275,000, a little more than expected. Unemployment did tick up a little bit. Average hourly pay ticked up to 4.3%. The last read on CPI or inflation, all items 3.1, core 3.9, heading in the right direction, still not where the Fed's target is. We get the next read on CPI next week. So what's next for the U.S. economy? It depends on who you ask. The yield curve still says that we'll go into a recession. Consumers believe that, CEOs believe that. Other banks, Goldman Sachs, Bank of America, don't believe we'll get a recession. So there are cases for both. So the bull case, which is the case against a recession, said that higher rates have not really impacted consumer spending yet. The bear case is that household debt, as we've talked about before, hit 17 trillion in March, rising 19% year over year, and that will eventually have an impact on overall spending. If we do go through a recession, it's important to look at what markets do before, during, and after a recession. So before, slight increase, during, actually a slight increase, and then 1 and 3 years after up. So kind of what this tells you is most of the market impact by the time we get to a recession has already reflected a possibility or probability of a recession. And this is going back to 1929. So some forward reasons for optimism that a recession is delayed and a soft landing is possible. The Fed cuts rates in the back half of the year, which is supportive of assets, and market performance continue to widen away from the Magnificent Seven that drove markets in 2023 to a wider grouping of stocks. Reasons for pessimism: we do get the recession, the consumer weakens, we've talked about this before, and the Fed cuts rates, but less than expected or is more delayed than expected. And of course, geopolitical is always a risk. And while we're thinking about this, I know this is a busy slide, but this talks about other periods of time where there's been heightened geopolitical risk going back to 1973. This talks about the duration, meaning how long it took for the markets to trade off, the size of the sell-off, and then the period of time before recovery. One of the interesting ones is the 9/11 that's in more recent memory. Trade-off of 6 days, sell-off was 11/6, and it only took 15 days to get to where we were on 9/10. So on average, if you look at these 50 years and 9 events, or all these events, you see that the duration of sell-off is about 9. -5 is the size of the sell-off, and it's about 11 trading days before you get back to where you were before the event. So geopolitical events are going to be with us forever, but it's important to look at history in the last 50 years and how markets have responded. So we are in a presidential year, as probably nobody needs to be reminded of. This is important to look at in terms of what markets on average do by quarter. So you'll see a mild upswing in the first and second quarter, followed by, in most presidential election years going back almost 100 years, the third and fourth quarter are much better. So none of this is an excuse to replace you contacting us personally to discuss how all of these things apply to you. So please do not hesitate to call us. We're here to serve you. If you have any questions, please let us know. So with that in mind, we'll close. Wish you and your families a happy March. We look forward to seeing you hopefully at our upcoming quarterly investment forum next month. Until we see you again, be well and take care.